Hello students, in this video we will discuss about type of accounts. Type of accounts. You know, there are two approaches for making accounts. Number one, modern approach, which is also called accounting equation approach, and second one is British approach, which is also known as old approach. First one is modern approach. Also called accounting equation approach, and the second one is old approach. Or British approach. We have already discussed about modern approach. You know, we divide our accounts in 5 parts according to modern approach. Number 1, assets account. Number 2, liabilities account. Number 3, expenses account, expenses and losses. Number 4, income or gains account. Number 5, capital accounts. So there are 5 types of accounts according to accounting equation approach. Now we will discuss about British approach. According to British approach, there are only 2 types of accounts. Number 1, personal account. Number 2, impersonal account. Number 1, personal accounts. Number 2, impersonal accounts. Further, impersonal accounts can be divided into 2 parts. Number 1, real accounts and nominal accounts. So you can say, in old approach, there are 3 types of accounts: personal account, real account and nominal account. In personal accounts, all the accounts related to persons are included. For example, Ram, Sham, Sita, Gita, capital accounts, drawings, bank, company, school, etc. In real accounts, all the assets account are included. All assets are included in real accounts. In nominal accounts, all expenses and losses, all income and gains are included. Further, personal accounts can be classified in 3 parts. Number 1, natural person. Natural personal account. Natural personal account means the accounts of natural person. Ram, Sham, Sita, Gita are natural person who can walk, who can talk, who can eat, those persons who are living persons are known as natural persons. So their account will be included in natural personal accounts. Ram, Sham, capital and drawings. Capital and drawings, both account are related to owner of the business. And you know, owner of the business is a human being. So that's why capital and drawings are included in natural personal accounts. Next one is artificial personal account. Artificial person means man-made person. The person which are made by man itself. For example, bank, company. They are not natural person, but they can purchase assets under its own name. They can enter into contracts under their own name. That's why they are treated as a person, but they are not natural person. That's why they are classified in artificial person. So these are some examples of artificial personal accounts. Farm, university, any institution. Next one is representative personal account. Representative personal accounts. Suppose an account represents one or more than one person. That is known as representative personal accounts. For example, outstanding wages account. Outstanding wages account will represent those employees or those workers to whom still wages is not paid. Prepaid wages account. Prepaid wages account will represent those workers to whom we have paid wages in advance. So there are three types of personal accounts: natural personal, artificial personal, representative personal account. Now real account. All the assets are counted here in real accounts. There are two types of real accounts. Number one, number two. Number one, tangible real accounts. Number two, intangible real accounts. Tangible real accounts, and second one is intangible real accounts. Tangible real accounts includes tangible assets accounts. What do you mean by tangible assets? Tangible assets are those assets which can be seen and touched, which are having physical existence. So the accounts of tangible assets are included in tangible real accounts. For example, cash, land and building, plant and machinery, furniture. These all assets can be touched and these are having physical existence. So their accounts will be counted in tangible real accounts. Intangible assets account will be counted here in intangible real accounts. What do you mean by intangible assets? Intangible assets are those assets which cannot be seen or touched, which are not having any physical existence. Goodwill, patents, trademarks, copyrights, computer software. These are some examples of intangible assets. So these are included in intangible real accounts. Now, what about nominal accounts? All expenses and losses. Expenses, wages, salary paid, rent paid, interest paid, discount allowed, depreciation, bad debts are some examples of expenses and losses. These accounts are included in nominal accounts. All income and gains income. For example, rent received, interest received, dividend received, bad debts recovered are some examples of income and gains. These are included in nominal accounts. So this is the point of type of accounts. Now rules of accounting. Rules for the journal. First of all, for personal account, the rule is debit the receiver, credit the giver. If the person in the transaction is receiver, he will be debited, and if the person is giver in the transaction, he will be credited. So the rule of personal account is debit the receiver, credit the giver. The rule of real account, debit what comes in and credit what goes out. Debit what comes in and credit what goes out. If any assets, when we are purchasing, assets is increasing, or you can say assets is coming, so that asset will be debited, and if the assets is going out, that asset will be credited. So the rule is debit what comes in, credit what goes out. Nominal account. The rule of nominal account is debit all the expenses and losses, credit all the income and gains. All the expenses and losses are always debit, income and gains are always credited. So these are the rules of accounting, also known as golden rule of accountancy. Thank you.